Why do 90% of aspiring entrepreneurs fail before they even make their first dollar? It isn't a lack of effort and it isn't a lack of capital. It's a structural misunderstanding of risk allocation. Most people believe that starting a business requires significant upfront capital to buy inventory, lease space, or file complex legal entities. They build an administrative shell around an unproven concept, incurring massive phantom overhead before validating market demand. True capital efficiency means minimizing your financial downside while maximizing your operational upside. Today, we are breaking down the top 3 low-cost frameworks that allow you to generate enterprise value using nothing but specialized knowledge, strategic positioning, and existing market infrastructure. The first model requires zero inventory and zero product development. It is B2B Service Intermediation, often referred to as service arbitrage. In every major industry, from logistics and container shipping to localized manufacturing, there is a massive operational gap between enterprise buyers who need specialized services and small independent contractors who perform the work. Your job isn't to buy assets or fulfill the service yourself. Your job is to act as a digital bridge. You identify corporate buyers facing inefficiencies, secure the contract, and immediately outsource the execution to high-quality independent specialists. The startup cost is virtually zero because you are paid by the client before you pay the fulfillment provider. You are trading on information asymmetry and operational efficiency, capturing a clean margin in the middle without asset liability. The second model targets the financial markets. The traditional route to trading commodities, base metals, or equities requires risking your own life savings. This is mathematically inefficient. Instead, modern markets allow for institutional leverage via proprietary trading firms. Under this framework, you don't trade with your own money. You pay a nominal fee to enter a simulated evaluation phase. If you can prove you understand risk metrics, drawdown limits, and consistent asset management, the institution allocates their capital to you. You manage their liquidity, take up to an 80% split of the profits, and assume zero personal financial liability if the market moves against the firm's capital. You are converting technical skill directly into scaled financial leverage. The third framework is the monetization of micro-niche domain expertise. Most people try to build broad, generalized educational channels or consulting practices, entering highly competitive, saturated spaces. Capital efficiency dictates that you find an incredibly narrow, underserved niche, such as supply chain optimization, specific scrap metal recycling workflows, or niche B2B logistics. By creating highly specialized playbooks, workflow templates, or targeted consulting frameworks, you create an asset once and sell it infinitely. The cost to produce a digital workflow tool or an expert brief is $0, yet its perceived value to a business professional facing that specific bottleneck is worth thousands. You aren't selling information. You are selling the elimination of corporate friction. The math of escaping the corporate loop is simple. Stop buying liabilities disguised as business assets. Don't buy websites. Don't buy corporate office spaces. And don't file paperwork for structures you haven't validated. Focus entirely on customer acquisition, information leverage, and asymmetric risk. Protect your downside and let the math handle the upside. If you want to analyze the precise mathematical frameworks we use to transition from corporate employment to capital-efficient assets, subscribe and follow along. Because protecting your foundation is the only way to build a scalable future.